Chapter 6, Trade Finance Facilities Funded versus Non-Funded and Event-Driven Risk. Section 1, Why Trade Finance Matters. Trade finance is the lifeblood of global commerce, enabling importers, exporters, and domestic traders to conduct business with confidence. It revolves around a sophisticated interplay of documents such as invoices, shipping papers, and customs forms, along with payment obligations and risk allocation among the buyer, seller, and their respective banks. For technology and risk leaders within financial institutions, a nuanced understanding of trade finance is not just beneficial, it is critical. Misinterpreting its mechanics can lead to significant and unforeseen financial losses. The inherent dangers in trade finance stem from two of its core characteristics. First, a substantial portion of trade finance exposure is off-balance sheet or non-funded. These contingent liabilities, however, can rapidly transform into funded exposures upon the occurrence of specific trigger events. Second, exposure is fundamentally event-driven and frequently spans international borders. This introduces a complex web of risks, including sanctions, anti-money laundering compliance, and country-specific political or economic instability. At its essence, trade finance can be conceptualized as a network of conditional promises. A bank, on behalf of its client, effectively states, "We will honor the payment obligation if our customer fails to do so, or when a specific set of documents is presented to us." Section 2, Funded versus Non-Funded Trade Exposure. A fundamental distinction in trade finance is the classification of exposure as either funded or non-funded. Funded exposure represents a direct outlay of cash from the bank. The bank has already disbursed funds to honor a client's obligation. Non-funded exposure refers to a contingent obligation the bank has assumed. No cash has been paid out yet, but the bank is committed to making a payment if certain conditions are met. Common trade products can be categorized by exposure type. Non-funded or contingent products include letters of credit, particularly import LCs, bank guarantees such as performance, advance payment, and bid bonds, and standby LCs. Funded products include trust receipts or import loans, export or invoice discounting, and packing credits or pre-shipment finance. The transition from non-funded to funded exposure is critical to understand. A letter of credit may start as a contingent liability, but when documents are presented and the bank makes payment, it becomes a funded exposure. This transition happens rapidly and must be tracked carefully by banking systems. Section 3, Letters of Credit, the cornerstone of trade finance. Letters of credit, or LCs, are the most widely used trade finance instrument. An LC is a written commitment by a bank, issued on behalf of its customer, the applicant or importer, to pay a beneficiary, typically the exporter, a specified amount of money upon presentation of documents that comply with the terms and conditions of the LC. The key parties in an LC transaction are the applicant, who is the importer or buyer requesting the LC, the issuing bank, which is the applicant's bank that issues the LC, the beneficiary, who is the exporter or seller receiving payment, and the advising or confirming bank, which is the beneficiary's bank that advises or confirms the LC. The LC process follows a specific sequence. First, the importer and exporter agree on terms. Second, the importer applies for an LC at their bank. Third, the issuing bank issues the LC to the beneficiary's bank. Fourth, the beneficiary ships goods and presents compliant documents. Fifth, the issuing bank examines documents and makes payment if they comply. Finally, the issuing bank debits the applicant's account or converts the LC into a loan. Section 4. Bank guarantees and standby letters of credit. Bank guarantees and standby LCs are similar instruments that provide a bank's promise to pay if the applicant fails to fulfill their contractual obligations. These are typically non-funded, contingent liabilities. Common types of bank guarantees include performance guarantees, which ensure contract completion, advance payment guarantees, which protect buyers who pay in advance, bid bonds, which secure tender participation, and financial guarantees, which back financial obligations. The risk in guarantees is that they can be called or invoked at any time if the underlying contract conditions are not met. When invoked, the bank must pay immediately, converting the non-funded exposure into a funded one. Section 5. System requirements for trade finance. Trade finance systems must handle unique complexities. They must track both funded and non-funded exposures separately. They must monitor document compliance and discrepancies. They must automate the transition from contingent to funded status. They must integrate with SWIFT for international messaging. They must enforce sanctions screening and AML checks. And they must provide real-time visibility into trade exposure across all products. Modern trade finance platforms must also support documentary credit workflows, guarantee issuance and tracking, and compliance with international standards such as UCP 600 for letters of credit. This concludes Chapter 6, Trade Finance Facilities Funded versus Non-Funded and Event-Driven Risk.